So.
Yeah, thanks for the introduction, Marty. So I'm a partner at Wilson Sonsini. We're one of the biggest startup law firms in the world. Have a lot of connections in the industry to VCs, high net worth individuals, angel networks, as well as representing a lot of the brightest and most novel technology and life science companies in the world. For example, we did the IPOs of Apple, Google, Twitter, LinkedIn, as well as the acquisitions of them. For example, LinkedIn by Microsoft, Twitter, by Elon, right? So we have like a lot of expertise in the area. In addition to like our kind of our connections, we also have a lot of industry expertise on the regulatory side. A lot of cutting edge knowledge about what the government's trying to do, legislation, things to look out for, and so all that knowledge we're able to give to our clients both on the investor side as well as on the company side. Maybe Aditya, you want to introduce yourself?
Of course. Thanks everyone. Good morning. These folks listening in the Bay Area. So my name is Aditya. I am a general partner, a founder of an early stage fund called BatVC. We're a team of entrepreneurs with successful exits, business leaders, P&L experience, and we've come together to form this fund primarily to invert the triangle of what we have been so trained to hear, that 90% of the companies fail, most of the profits generated by 10% of the companies, and we have formed the fund to basically invert that, at least for our set of investments, where we believe that we have the framework and the approach to do deal sourcing, evaluating deals, and then supporting the companies to make sure at least the North Star is that 90% of our investments will thrive and be successful in some way, shape, or form. We feel it's a more effective and efficient way to not only preserve capital first, but then also sort of grow that capital over a period of time and generate 5x return for our investors.
Thanks for the introduction. And then I know Tracy is on Zoom, so maybe Tracy, you can give a little bit of background about yourself as well.
That sounds great. I came from the investment banking side, and third generation from California, have invested through a family office in venture. And not only have I invested and I own venture deals myself, but then saw an opportunity to coming from investment banking and venture. This is an amazing time to actually have a fund that has capital to invest in venture, and we're going to talk about that. And we focus on financial technology. We're an all-female team, and all of us have had extensive experience in financial technology, managing financial technology for large family offices, managing financial technology, and also investing in financial technology. So our experience is really focused with regards to why we started the fund.
All right, thank you for introducing yourself, Tracy. And so maybe I'll kind of kick it off asking kind of a very high-level question to the panelists. Aditya and Tracy, what do you see as being the outlook for venture capital the next 12 months?
I'll go first, Tracy, if that's okay.
Sure.
So I think when we think of the outlook, we have to also understand, in our view, where we are coming from. And I think if you look at the cycle in 2019, where people already thought that things were different and inflated from 2016 and 15 vintages, then came 2021, where everything is out of the whack in terms of the valuations and the money that was being raised and deployed. And now, so to speak, we have sort of hit the wall in terms of the number of funds that are being raised, the capital that is available. And I think we all know the reasons for it, primarily driven by quant easing, the COVID money, the inflation rates that sort of have resulted, and the slowdown in the economy. And I think that has created a very interesting space for VC, which is with the emergence of newer trends like generative AI, what we are seeing and what might happen in the next 12 months is there will be flight to safety for most of the money, and which we are already seeing some signs for, which is people investing in companies with at least 1 year of revenue track record. And that has increased in the last quarter over quarter, if you look at those trends. There is people want to invest in companies where there are repeat founders. So that again, in the VC world, it's flight to safety. We're seeing money going into later stage companies because the valuations in the late stage have come down significantly, anywhere between 25 to 60%, depending on your sector, theme, and the company that we are talking about. So I believe that there are a lot more good deals available, or will be available for investments, and 2023, early 24 may turn out to be good investment years. But we have to, I think the valuation in some of the companies and the funds will come down as they mark the market, and these existing portfolio companies will raise. So there's a bit of reluctance that we'll see from the investors to deploy capital, at least for another 6 to 9 months, until they're sure that all of the current investments are marked to the current market. Tracy?
Yes, I agree there. What's interesting that's happened, I think we're getting close to a floor here. I think there's still a lot of companies, especially in the earlier stages, that can't raise capital, that don't have follow-on capital, that won't be around. But we have seen this year, because of especially around now and the last several months, private equity firms are looking at smaller deals and investing in earlier stage companies because the valuations are so attractive, and they see a number and acceleration of growth opportunities. I think there's a lot of interest in the earlier stage companies as well, because valuations have been crushed, and there's an ability to negotiate terms and be able to get into these transactions. And these are deals that I'm seeing even that are third or fourth founders for these companies have founders that have exited number of companies, and this is their third company or their fourth company. And so there's a lot of interest there. I think this is going to continue. I do think the first quarter in venture of next year is going to start really picking up. A little more than what we've obviously we're getting hopefully close to a bottom in venture. As I was talking to Marty before we got on the call, this is to me 2008 mortgage crisis. This is the 2023 venture crisis. And but out of that, just like out of 2008, there's huge opportunities to invest in exceptional founders, as you mentioned. And I think that is a big deal. And staying in areas that are specifically going to grow and accelerate and needed in the marketplace. Financial technology, further along, health tech, because those deals take a long time, climate, and generative AI is just a big area. And a lot of money came out of stopped going into Web3 and started going into generative AI. So I think that's going to continue as well.
And so, Tracy and Aditya, you brought up some interesting points. So I just like to maybe drill down into kind of what do you see as being, funded right now, and why? Is it like the attractive valuations? You mentioned revenue, having plenty of revenue, founder expertise, right? But what are the things that you see as really, accelerating, VC investment, and right now things that are keeping current companies alive?
Tracy, do you want to go?
Oh, sure. I'll go. Well, I was at this week, I was at an event at The Economist, and the panel was specifically on generative AI. And they talked about how money has come out of, or money that was going into Web3, for example, or other VC deals were actually now going into generative AI. So that momentum is going to continue, specifically on the AI. Everybody talks about it. I think the area that's going to accelerate is digital identity. That's a crucial area for venture. And obviously that's in the fintech area. When I have looked at deals personally, and I have a portfolio of deals, I have looked at founders. I think that is so important. None of us expected to go through the period of time that we went through, and the deals that are accelerating, and those founders were able to keep those businesses alive during a period of time. And I think more than anything else, that's important. Valuations are important, and terms around those valuations are important. I think you're seeing like pre-seed, a lot of investing going into pre-seed deals, but seed deals for sure, and Series A. But it's important to look at those deals specifically that have revenue. I've talked to a number of founders that I've invested in, or I have talked to about future investment, and their comment was, we're not going to raise a Series A until we get break even, because they're going to get crushed with regards to monies that is going into their deals that could affect their ability to raise capital in the future. So I think there's a lot of that, whereas in the past, it was like, okay, we're going to raise a Series A and you're nowhere close to break even. So I think looking at where the founders are as far as the acceleration of their business model and their revenue base is going to be extremely important.
Yeah, I think I concur, and I'm going to build on what Tracy just said. If we look at the average runway for the startups at any stage, that has increased from average of 18 months to 24 months. The burn rate has declined at an average of 15 to 20%. And I think all of those are signs that if you are, as a founder, if you are building a platform for creating a good business, you will still get funded. But if you are burning capital and you're in the name of experimentation and you have not done this before, the chances that you'll raise your next round has decreased significantly. And so in terms of what is getting funded, I think investors are getting super smart. When we talk about fintech or any other broad theme, they're not blindly investing money in all the areas related to fintech. So for example, when everything in the fintech from the valuation perspective was down in the last couple of quarters, climate fintech did exceedingly well, both in terms of the valuation and also raising money. And why is that? I think people are expecting that the ESG guidelines are going to come down heavily on the buildings, and the companies will have to put systems in place to report the carbon footprint and how close they are to carbon neutrality. And that means a ton of data that is being collected. If SEC sort of comes down and creates a law that you have to report that. So there is a lot of work that needs to happen, both in compliance and data analytics and gathering around that area, and it's a huge market. So the tracks are being laid for eventual change in the law from the ESG perspective, and it's a growing trend. Similarly, in generative AI, I know there's a hype around OpenAI, but there are a couple of use cases. They're big, broad ones, right? One is the productivity increase, which I believe there will be plenty of companies, and it will be hard to sort of create value there. Someone can compose your email and summarize your call logs. Yes, it's effective, but how much real value has been created there? But there are use cases, for example, in medicine, which is billions of dollars are wasted in phase 1 and phase 2 clinical trials. And I think the generative AI can help there in looking at the binders that are created, the protein combinations, to effectively increase the probability of drugs getting past phase 1 and phase 2 trials. So those new cases that were not possible with the existing technology, I think that's where the new value is going to get created. And those are the projects that will likely to get funded in this market.
And I think those are all good points that, both of you brought up. Kind of going off of one of your points about, like regulation, right, the government, the SEC, how do you see, the potential, government shutdown? How does that impact your investment analysis, right? Your feel for how companies are going to react to that. Plus, we have, these congressional hearings about, or, the trials about, Google and like the anti-monopoly thing expand to Amazon, Facebook, or Meta. Like, how do you see those things impacting your or VC, decisions to invest and, expanding out maybe the potential floor that we're at right now?
It's a great question. So I can talk about our approach rather than broad VC approach. I mean, for us, it's VC investments by very nature. It's a long-term investment. It's hard to react to CNBC breaking news and CNN breaking news about what's happening in the government, because that might very well change in 2024, right? But we do keep an eye on long-term implications, rules on laws where at least both the parties are supportive. So, for example, mental and behavioral health is an area where you have bipartisan laws. Infrastructure is an area where we have bipartisan laws. So we look at those trends and see those are more secure directionally for the next 10 years, where we can put a marker in place and say, hey, yeah, this is investable. But other than that, yes, there will be short-term pickups if there is a government shutdown, but that doesn't change, in our view, of what we will invest and what we will not invest on, for at least for the 5 to 7 to 10 to 5.
And Tracy, you back for that?
Sure. I'll just make a quick note of that. It was interesting at this event. There's two things. One is I met someone who just raised a $500 million fund, and they raised it. It took them a lot longer than they thought. Sophisticated investors, first fund, they raised 500 million, and what they invested in specifically was any company relative to data. So they believe that the generative AI is going to be important, but so they want to invest in as many data companies as they can. They don't care if it's in fintech, health tech, whatever they can invest in. So I thought that was an interesting trend. There are, with regards to regulatory, I think that we will always have these regulatory headwinds, and it doesn't matter, but there are certain areas that have them more than other areas, like healthcare has a lot of regulatory, headwinds. Climate, right now, it's been an accelerated area, and it's in the positive. The regulatory headwinds are really in the positive area. You're going to have it in fintech, but I agree that you have to look at the big picture. Where you have to be careful is in certain areas where you feel like the regulatory environments are going to stifle any kind of acceleration or growth. I know we're seeing that in the social media area. Is that going to affect consumer brands? I'm not in that area, but I think looking at it from a big picture perspective is really important. And also looking industry focused. Is it going to affect us as we move forward? And I think specific areas that are over-regulated. I do want to mention this bill that's on the governor's desk to sign. And Eric, I'm sure you're very familiar with it. It's SB 54 by Skinner. And that bill is specific to basically tracking diversity reporting. And it's going to be affecting not only venture, which is going to affect venture, but it's also going to require hospitals. It's going to require the state bar. It's going to require a number of other entities, CalPERS and STIRS, to start doing diversity reporting across all of the sectors of which they operate, whether it's investment in venture, whether it's contracts they let. And so I think that regulatory environment is going to affect, because these entities are going to have to put more money into actually hiring people, and it's going to affect their bottom line. So maybe, Eric, that would be a good topic, because it's a big deal, and it could go across the country.
Yeah, we'll be putting out kind of client alerts on those matters as get final resolution on it, right? The impact it has, to the investment community, and so we'll be able to send out. Be sure to sign up for our newsletter or client alerts, and we'll get that information out to you.
Okay, great.
So maybe I'll kind of track back to the investment side and kind of asking how do you see deal flow happening now, right? Historically it's it maybe relative to the past 3 or so years, and then do you feel that VCs are abandoning or redoing rounds of current portfolio companies? what is causing them to be able to, deploy capital when it's really stretched right now?
Do you want I'll take that to begin. I think there's ways to evaluate deal flow, and we're seeing a lot of companies that are this has been happening already in private equity a lot. And so because private equity was able to use AI or other means to basically evaluate data in order to make decisions on what they invest in. I think because venture has been, and those companies, the amount of data that was available, it was very opaque. So you really didn't have a sense for the depth of what the industry was in those specific instances. That is all changing. There's a number of companies now that are looking at AI to evaluate deal flow, that are looking at AI, and there's a number of data companies that are have collected enough data on venture deals to be able to evaluate what the rounds are, what the future is, and what the industry looks like in general. So I think that trend is going to continue, and it's going to continue accelerating, both on the AI side and looking at AI, and also being able to structure machine learning models. There's still a personal element to it. So, for example, I talked to someone that's going in and scraping the web and looking at certain criterias like founders and how many deals they've done and how many exits they have. And then they actually try to see if they've set up a new company. And then they actually physically contact them and say, hey, I want to be in your round. Who's in your round with you? So those are things that are going to continue. If we're talking about deal sourcing outside of the traditional, I know several founders that have done great deals, and I want to be in their next round. Outside of that tradition, I think this is going to continue.
I have to jump in here. I'm not sure exactly what you're saying, Tracy. Are you saying that the value of a deal is going to become uniform?
No, not the value. I think the question was, how do you deal source? That's what I heard the question was.
So you're saying that you can deal source from scraping the web?
No, I'm not saying that you can deal source. There are companies that are doing AI and providing analysis and collecting enough data to be able to evaluate and estimate who's doing the next round, how much their next round is going to be, what industry it's in, because there's enough data that's being collected in the venture space now where it's been very opaque in the past. And so there are firms we talked to one recently in the East Coast that is doing just that. I've also talked to a couple of portfolio managers that are with pretty large institutions that are doing what I just said, that are going.
What series are you talking about? Series A or seed or Series B?
I'm talking about all the Series A, the Series B, the Series C, a number of the series going all the way across on the venture side. I mean, I'm happy to give you the name of these firms offline, Marty.
I'm just trying to understand it because to me, it seems like at least at the seed stage and probably at Series A as well, that there's a lot of, founder chemistry issues with the funders. And then the other issue is who's on the capital stack, right? I mean, that's, to me,
right,
the incredibly ignored issue in venture capital, because I think that the Jobs Act mucked things up with being able to have all of these accredited investors, is that a lot of family offices don't want to be on a capital stack with 100 other people.
Yeah,
right?
no, Marty, what I'm saying is just in the identification in specific areas, it's not just all done through AI. It's just the identification. It's still a personal relationship and contacting those founders and say, hey, this is an area I want to be in. And I know you guys are raising your next round. And we want to know more, like who's on your capital stack and how many investors do you have? And I want to be part of that round. But we were talking specifically, I thought the question was about deal sourcing. And my point is that it's still a personal relationship. But there's a lot of great founders out there, one specifically that I'm thinking of that was in the gaming space that just is coming out with this third company, but people would not have known because only certain venture firms get involved or invited to join his seed round or his pre-seed round or whatever it is. But they actually, this company and this firm wanted to be part of that round and identified him, even though they didn't know him, as this is a person I want to work with. And then they contacted him directly. So I'm saying it's a combination. It's not just
Got
what
it.
I'm saying.
Sure, it can be of assistance. Got it. Yep.
I think it's and correct me, Tracy, I think what she's talking about is there's a better way that you can do outbound reach. And I think it's just leveraging technology and getting ahead before anyone else gets to the founder who is thinking of starting, a repeat founder who is thinking of starting a new company. Referrals, I think for us, founder referrals are by far the best way to have a unique deal flow. Particularly when the founders think that we could be instrumental in the first 18 months and will help them preserve their portion of the equity. And I think that part is really, at least from our perspective, really resonates with the founders, and we're getting a lot of founder-led referral deal flow. Inbounds, I think everyone has access to the same deals, and if people are saying that those are unique, they're probably lying, because everyone is on YC, everyone is, gets tech stars, and there's a list of deal flow that floats around. So everyone has access to those, and those are easy ones. And investing alongside another fund, I think it's great. But I think anyone who's looking for alpha, people are asking, okay, how many of these were unique, where you were the first? And I think what Tracy's talking about is one of the ways you can get ahead. And the second is just the pure relationship where the founders really come to you and say, hey, we want you to be on the cap table and help us sort of beat to the next round.
So I think we discussed this in the AI panel yesterday, which is that the great value of AI is that you can look at a massive amount of data and score it immediately.
Yeah.
All right. And I think falls into what Tracy was saying, right? As a first line of really evaluating stuff. If you can look at the Y Combinator stuff, and the Techstar stuff, and then this massive amount of stuff that's you scrape, and then score it all immediately, that just saves you so much time.
I mean, those analysts used to do that job, and I think the point is now your analysts can be a little bit more advanced, and they can leverage this data to actually evaluate some of those deals. So it just accelerates to get to the right investment. And if you're looking for that unique deal, that is the difference between you getting on that deal or not. If you take time, otherwise some of these rounds are closed. Most of the good founders are they have connections where they raised previously. The first call goes, and the next day the round is taken. It's just very hard to get on those unique deals.
Yeah.
That's exactly what I was talking about. And this is the example of the gaming founder. And they got a call from a very large institution that has a venture fund. They don't typically do a lot of venture. And it was like, we want to be on your cap table. And they say, why? Our cap table's closed. Tell us why we should have you on our cap table. So that was identified through their machine learning models that they personally put together, exactly what we're talking about. They didn't know this founder, but they knew that this was a deal they wanted to be in, and they wanted to work with this founder. And so you have to do personal conversations with their models. Exactly. So it's I think that combination will continue.
And so we kind of talked about deal sourcing. Maybe you could talk about maybe the role of either the state of the economy, right, for capital, or like AI, machine learning, in terms of once you get the deal in, right, how your timelines have either expanded, right, or the negotiations have expanded, kind of things that you talk about in light of the current economic conditions.
Oh, love it. That's my favorite topic, because I think starting a fund is in an environment and raising money and deploying it has been phenomenal for us. I think the part of it is you can now have a commercial conversation, and the due diligence timelines, in our view, are now at the right number, anywhere between 3 to 4, 5, 6, 8, depending on what stage you're talking about. But there is a lot more appetite for the founders to listen and answer questions. While in 2021, it was, hey, I really like what you're doing, and either the answer is the round is taken, or you have 2 days to make a decision to invest in us or not, otherwise the round will be taken. And I think that has really come down, and that is good for the industry, in my view, for the long term. From the VCs, from the investors' perspective, because we're getting time to really understand if these companies or these ideas can potentially become businesses. And I think, as I said, those timelines, in my view, have stretched anywhere between a week or two to actually 6 to 8 weeks. And we are taking roughly around, I think our average timeline is anywhere between 4 to 6 months.
So one thing I'd like to say, I mean, the venture space is, you're looking for exceptional founders. And what's really, and I think the panelists that we're talking about is one of the things that we bring to the table, both of us, is that we have expertise in the space and we have operated businesses in the space. And our team has operated a number of businesses or have worked in fintech. And so one of the things we're providing is really an operating aspect to the investment. And I think that's what needs to happen in this space, because founders are spending so much time on the administrative portion of their business. They're spending so much time on finding the right tech team and, human resources and build and all that stuff. So if you can not only provide advice to them, but also provide resources there so they can focus on their business model and actually accelerate their businesses, because we're investing because their business model is great, but running a business is not an easy process. And I don't care if it's a venture, it's an early stage startup. And so when we're looking at how do we make the investment, one of the things that we did with our fund that we really focused on is to also be able to bring those ability to provide additional services to help our venture, to help our companies that we invest in be able to accelerate, help them with tech solutions if they need it, because our team is pretty deep across the line on the technology side. So I think part of that for founders, they need advisors. That's why they bring in advisors. And so why not have your investors be strategic? And that's what we're talking about. Have your investors actually bring more to the table than just the money, because that's what they need.
And so I think that's a good point, right? Like, it's not just money that like VCs are bringing to the companies, right? There's also like expertise, right? Connections, contacts. So maybe you can expand a little bit upon that, right? Like what role you see yourselves, right? Once you've invested, right? What kind of objectives you set forward, to the founders, right? Either as part of the negotiations, right? Or maybe, once, if the investment is accepted, right? You're on the board or you have some sort of, some control rights, some approval rights. How do you take advantage of that?
That's a great question. Again, Eric, what we are doing and for us, it starts with how we do the due diligence process. We look at roughly around 50 odd variables that, in our view, potentially impact that business. And those variables typically then, most funds have those at least 4 buckets, which is team, market, product, and financing / financials. What we do is during the process, we not only try to identify the strengths, because those are the reasons why we invest in those companies, but also the areas where we feel there are gaps in their ability to make a meaningful impact, at least in the next 18 months, to get another round of funding. So on day one, we have a pretty detailed view on what these people are lacking and where we can add value starting day one. So what I do is, in addition to getting on board observer positions, and if not, then I negotiate, if not bi-weekly, a monthly meeting with the CEO. On day one, we lay down the plan on where the gaps are. There's an agreement, otherwise we don't invest, and then how they're going to build on fixing those things. And what these founders sort of learn over the period of doing that 2 months and 3 months, that it is actually helping them. In a couple of areas. One is strategic experimentation versus just throwing things on the wall and seeing what sticks in the name of experimentations. They have clear idea what they're testing, with which kind of customers, what are the metrics that they need to see to define whether this is successful or not. So for that purpose, we use benchmarks, external, internal as well. And the second thing is ability to forecast, which is extremely hard in case of a startup. But we get them prepared and start building that muscle early, so that like a minor and major league sports, by the time they get to raise to the growth capital, the foundations are in place where they have a good blueprint on how they're going to scale this business. And I think that is the journey that we follow with all of our companies where we invest. I think for the first 18 months are extremely.
I'm just going to agree with that. I think that's a very accurate presentation of how we look at this as well. And we also provide additional advice with regards to technology and, general things that really are things that they have to do to operate a successful business, but take away from their ability to focus on roadmap, scale, and projections. And so we want to be able to provide that as well, along with exactly the advice that was just presented, which was excellent.
And, one of the things that companies always need to do, right, is to figure out, right, their cash burn, the runway when they need to raise money again. And so I'm sure that there are times where, you are, the only, investor, the only VC perhaps, right? But perhaps you can talk about, preparing for the next round of financing, syndicating around investors or other VCs maybe that you're philosophically aligned with or that you have experience with, like what are the things that are important for you when building up a meaningful round of investment with people, either work with the past or about?
I think for us, it's when we go in a deal, because we are not the biggest check in many instances, we end up investing alongside funds where we have identified the funds whose decision-making process at least we can get behind and we respect, particularly the ones who lead the rounds. So if their philosophy is to spray the money around across 100 companies and two will work, we don't invest alongside them, regardless of the size of their funds. We just don't. But there are funds which spend time in the due diligence. We may differ in the nuances of how we do it, but we can respect. I think that then starts to lay down tracks for the first 18 months when we are sitting on the board. As I spend as much time with those fund managers to sit down and talk about what it would look like at the month 14 and 15. And how can we help this company and what needs to be true? What are the critical conditions from ops perspective and the financing perspective that needs to be true for us to go to the market and bring in other investors if we are not the ones who are investing and taking on the full round. But those are, in my view, most funds do that. It's a normal conversation. It's also best practice to be in sync with other investors. If you are on the board, I feel it's my duty to involve other investors regardless of the size of their checks.
I'm just make a statement since I have invested into a number of VC related transactions, mostly in the seed and Series A round. I am very aware of capital that I deploy and capital that comes in to the fund or my ability to deploy. And I think there's a level of, focus and respect of that capital. And you want to do everything you can in working with the companies you deploy into to make sure that capital is well used. And I think all of the things that have been mentioned are really along the path that this capital is well used. I think pre this period of time, there was a lot of just keep raising, burn through, keep your, you don't care about your expenses, just keep burning through and making sure that you just, keep raising the next round. I think that whole is gone. I think now it really is making sure that every dollar is spent in order to take this company to the next level, regardless of what the round is. And I think that's what the most important part here in venture is for any investor when they invest, and anybody that goes on the cap table is just not taking up real estate on that cap table, but actually providing the services and the support for these companies to go to the next level. There's so many companies I see where the cap table has like 170 investors. It's just a mess. It has to be redone. And then they have to set up a new company to move all that into another, that's their group. So to be able to have the right investors and that can bring something instead of just capital, obviously is very important, but you need both.
Yeah, I'll just give a quick example of something that we're dealing with right now. So one of our portfolio companies in the government tech space, B2B SaaS, is approaching 10 million ARR, which is an incredible number, and for the Series B raise, and there is an interest from some of the top funds to lead that round. And what those funds have given them is a bunch of benchmark metrics. Say, hey, meet these, and then we're going to invest. So there was dichotomy whether we abandon what the board has set forward, which is cash flow positive and building good business and chase growth at any cost. So I work with the CEO and start sort of pivoting the plan and say, we got to go back and get the right funds involved versus changing the strategy to chase some metrics, which God knows who created, in what time, why are they getting it? They're not giving guarantees. So I think those discussions become very meaningful when you tell the founders that stay focused on what is meaningful, that it's create a long-term value for the capital that is already in, versus just keep changing the goalpost because someone is interested in giving you more money.
I think that's a good philosophy to have, right? Like, companies should be doing what's probably right for the company in the long term versus chasing short term, maybe manufactured metrics to get the financing in.
But the funds have trained them to do just that.
Yeah.
I mean, that's the reason why we are in this cycle, because we invest in 18 months period, not 10-year businesses. And that's our fault. I'll put my hand up and say it's our industry's fault. Because we tell them that, hey, if you get 5 customers and this much ARR, that means you're on the right track. That initial traction is by no means the guarantee of your future success. Most of the YC companies do that. If you see their traction and they have their own model, it's within the same companies. So one YC company is selling to another YC company and they say, oh, we have 50K ARR out of the gate, but that's just synthetic ARR. There is money floating around. And if you don't see that, end up investing in that company, they don't even have product ready. And the valuation is astronomical.
Yeah.
Anyway, this gets me riled up, but.
So I guess, Tracy.
No, it's a really good point because there's also this, if you just change this a little bit in your technology, then you can bring these other customers in. And so you have to caution when you're investing in these companies that if the model is really where it should be, you can't keep just going off on tangents because that's not your business model. So it's the same thing on the product side. And it's really staying focused and true to what the company was set up to do. Also being able to pivot quickly if you need to. But
it's actually a very strategic issue, right? Which is, if you have product creep, the people invested in you to do the thing that you pitch them. And how do you know that somebody, if you're trying to make a slight pivot to something different, that hasn't already been pitched to your investor community, right? So there's almost a fiduciary sort of thing going on if you change direction too much.
So I know that we're running out of time.
About 10 minutes.
About 10 minutes left? Okay.
And I have lots of questions.
Yeah. So I guess, Marty, are there any questions from the audience? Or
you have a couple questions here?
Yeah.
Yeah, I'm sorry. You may have said this in the very beginning, and I apologize, but how much have you raised or are raising, and how much do you invest in each individual investment? I'm just curious about the structure of your funds.
Yeah, so we've raised, the fund is closed, at least from our perspective. We've deployed 40% of the fund already, but we have a ton of dry powder. And our typical check sizes when we invest in the companies is anywhere between 200, 500K. We don't typically keep reserves. for future rounds. And what we do is we try to do a good job up front and invest whatever amount we think needs to be invested. Because we've done the math that if you keep investing, the weighted return on your investment is less than if you invest well upfront. So we trust our process, try to do most of the investment upfront without checks.
Okay, so how much have you raised for the fund? to date?
Total what we have raised,
Yeah,
we have raised 10 million.
okay.
Yeah.
Got it. Thank you. Tracy?
Yes, we are in the middle of a capital raise, and we started that just about 3 months ago. We've had conversations with and we have soft circled several million, and we are raising a larger round. We are raising 100 million.
And how much do you invest in each particular
We invest
opportunity?
it's between 1 to 2 million in each transaction. But we're looking at seed and Series A, but the Series A, some of the deals that we have actually been seeing should be further along Series B, but capital constraints, it's giving us a great opportunity to look at investment in those companies. So we have done a thorough analysis as to where we want to be. We want a larger position in the earlier stage companies because we are keeping about 20 to 25% back for follow-on.
Got it. So you're investing between 2 and 4 times the amount that Aditya
Yeah.
is investing.
Yes, and our model is very specific. We have on board, one of our team members has built end-to-end technology for pretty large institutions and family offices, the DE Shaws, pretty large family offices. So we are able to evaluate the technology on the financial technology side right up front because we've seen a lot and we know when there's an opportunity. And we spend some time negotiating and making sure we know the founders but we want to be a little bit bigger position in the earlier rounds. I mean, that's our business model.
Along the same lines for both of you, I wanted to get a better sense of is there a specific niche or market or, I invest in technology. Well, that could be anything. Is there an area that you have a specific specialty in that you're better than everyone else in the industry that sets you apart?
Yeah, I think I'll take a stab at answering that question. I think for us, when we say fintech and tech, there are specific use cases that we go after. And that use case is a function of our expertise in that area. So within fintech, it is in the lending space, wealth management, advisory. In the B2B SaaS space, it's in AI and enterprise software. That's where we have had exits. In the health tech, we invest in 2-3 areas. One is at-home care, mental and behavioral health, and cancer detection and diagnostics. Those are the 3 areas where we have expertise in the fund. And the last is Web3 and Metaverse, very specific use cases in sales and marketing and hybrid workspaces. And the third is retail and shopping. Those use cases are a function of how big is the market, where the opportunity is, how many companies are already solving those use cases. So it's a combination of what people are pitching us, but importantly, where we see value. And once there is a combination of that, we tend to look at those investments.
How many partners are you? How many folks are you?
We have 3 partners. We have 8 active members in the advisory council who work with us very, very closely.
Tracy, the same
Yeah,
question.
we are focused on financial technology, only financial technology, but that encompasses digital identity, it encompasses AI, it encompasses a number of areas in financial technology because all of the team's expertise, we all have diverse expertise, but most of our team's expertise is in technology, financial technology. having worked at large institutions, most of us having worked at large institutions, having worked at large family offices. And there's 3 partners, and we have another partner that will be coming on. She's specifically worked in all of financial technologies, worked at BlackRock. She's worked at a number of different large firms. So that's her expertise. We do have several advisors that are and focused is
Tracy, I'm sorry, Tracy, one of the other issues I had for you is if you put in $1 to $2 million into an investment and you're saving 25% for future add-ons and you're raising $100 million fund, you're talking somewhere between 50 to 75 investments, it would seem to me. Isn't that a lot to kind of?
No, I mean, I won't get into all our financial model, but we're looking at, no, it comes to about 30 plus investments is what it comes to. And so we're just talking about a range here. And I didn't get into all the specific details of it, but no, it's when we look at the follow-on, we look at what we're investing in Series A, we're looking what we're investing in seed. You just asked me like a range, but
Yeah.
we different model that we're investing in the Series A versus the seed. So we average the number of investments based on our model is 30 plus investments. And I'm happy to share that model with you.
No, sure. I mean, you're giving me broad general answers.
Yeah,
and
general,
the specifics, it breaks down differently.
Yes.
How much are each of you putting into your funds? How much are the partners putting in to these funds?
So we have put $1 million, a lot of which is unusually high for the size of fund.
About 10%.
Yeah, that is high. 10%.
Yeah.
A big number. Tracy?
Yeah, we're putting in a quarter to a point. We're in negotiations on that.
Understood. No, thank you. I just want to get a better sense of your particular models.
I had another question. So are you guys typically lead investors or co-investors on new deals?
Mostly co-investing. At least that, and Tracy may have a different answer because she's a larger one.
We would lead. It just depends on the transaction and the valuation and where they are. So we would lead and we would co-invest.
Who's likely to co-invest in your deals? Tracy, who's likely to co-invest?
Are you talking? I'm sorry, Marty, are you talking?
Tracy?
Yes, no, I mean, we would, a number of different firms would co-invest. I don't know if that's so the answer is a number of different firms would co-invest with us. I mean, we've even talked to the panelists about I mean, anyone who has an expertise that can bring strategic capital, we would look to co-invest with.
And Tracy, you've been an angel investor for a long time. You've invested hundreds of thousands, millions of dollars?
In the millions of dollars range, yes, I have. I left investment banking and I started investing in early stage deals, probably when Lending Club was around.
So like 2009, 2010?
Yeah, in that range, yes.
That's a pretty long period as an angel investor. So that's really great.
Yes, I mean, there's periods of time where I invest more than other times when I invest less. And I can tell you, from my experience, it's always the team. No matter what, it's always the team, and it's always staying true to their product and staying true to their vision and being able to carry it through the most difficult of time.
That was my issue with the question of scraping the web, is that I run into people who have the same ideas as everybody else. Like every time one person has an idea, there's 20 people who have the exact same idea. And it's really all about, is this the team that's able to make it happen?
Yes.
Does that make any sense?
Yeah, no, Marty, that's exactly it. And the person I mentioned that's scraping the web, they've sold 2 companies to very large institutions. And basically the companies they sold were exactly that. And one of their companies is now being used as the basis for a fund for a large institution. And they're putting about $1 billion to work in that model. So the person I mentioned is very sophisticated with regards to building machine learning models, and this is one of the ways they do it. So it is the people. I mean, if, you know, if were you and I just said, I'm scraping the web tomorrow, probably not, or myself, it's probably not the model. I'm not creating machine learning models. So yes, completely understand.
I just find, and maybe you want to answer the question too, Aditya, about, you know, the people versus the project?
I mean, team is obviously, and from the weightage perspective, at an early stage, clearly has higher weightage. Can they execute? That's where most of these companies fail in failure to achieve product market fit. So, so that is important. But I think in addition to that, it's also important if they're solving the right problem, and if they're solving for customers who already have budgets in place to buy the product. I think that is important because sometimes we feel that as we solve this problem, they will be buyers and we kind of start doing it, but then companies don't change their budgets. It's hard to change budgets. And so I think we focus on, is this a product that solves a real problem that people invest in addition to, is this the right team to actually go and have those conversations at a C-suite level when we make introductions that, hey, this is what you should invest in. Those two are.
Yeah, one last comment I want to make on the team, and I think you're absolutely right, because I think 40+% of these businesses fail because of product market fit. You have the right team, but you have to make sure that the team has a background in what they're doing, because I've seen teams like just, oh, you know, they were, you know, in healthcare and now they're setting up something like an eyeglass store. So are they, which maybe if they were an eye doctor, that may work. But what I'm saying is they should have some kind of a little bit of expertise in their background and what they're setting up as a company so that they understand what the pitfalls in that industry are, including regulatory.
About 2 minutes.
I guess, final question, do you guys only invest in equity, or do you invest in convertibles as well, like notes, safes? Like, what's your viewpoint on that?
I mean, at an early stage, it's I would say we have 50-50, but we don't have a marker. In some deals we're investing in safe. In this environment, I think that we can do side letters around safe to get favorable terms. If we feel that there's a need to protect the downside for our investors, be it liquidation preferences, be it MFN rights, that sometimes are included in the safe and sometimes they're not. So, and also equity. So it really depends on deal to deal, but early stage nowadays mostly safe. Yeah.
Yeah, our preference is preferred equity. That's our preference. I mean, I've set up other companies myself and I like to invest in preferred equity. Personally, I have invested in safes. I've invested in notes. I've invested in across the board. And again, I'm not going to say that our only criteria is preferred equity, but we do like preferred equity. And especially in a market that's difficult like this, it's good to be able to negotiate those kind of terms. Now, if it's a safe, I wouldn't want to put restrictions around that, what the valuation is, other things like that when it converts, to make sure that our investors are taken care of on conversion.
Any closing thoughts? Hello?
Yeah, I would say that if I can leave with this, that this is a great time to invest in some good projects. I know some good founders are taking a backseat and starting companies. Some of my friends, at least, are holding back for a better time so they can raise. But there's still some great projects. Series A valuations, I believe, are very attractive. That also gives you a bit of runway because B and C valuations have also come down, but they'll have to sort of prove out quickly so that they can get on the path of the exit. But A allows you to ride the market, the short-term distraction for a long period of time. So Series A, good founders in areas that will grow regardless of which government is in power. I think this is where I would put the pin on.
I'm just going to say, I think it's an exciting time to really, once you find the right yield, It's being an investor in venture personally, I can tell you that working with founders, hardworking, I'm a third generation entrepreneur. So people, entrepreneurs are just a special breed on themselves and they're optimists. And it's fun to work with entrepreneurs that have a vision, that are here to make changes. And I think it's an excellent time to look at these venture deals, especially on the early stage side, and, make the investment, because this is to the bottom from what I have heard in the market is that, and what I'm seeing is that the values are going to increase slightly, especially on the earlier stage side going into 2024. And so it's a great time to work with great people and invest in companies that are creating the future. And thank you, Eric. Thank you to panelists. Really appreciate this panel. I think we're all passionate about venture here, even on the law side. And so appreciate continuing the system, because it's really important to support entrepreneurs and early stage visionaries to continue to grow and expand innovation.
Thank you, everyone.
Thanks, Marty.
Fantastic, great job.
Marty, thank you.